So is the traditional 60-40 mix of stocks and bonds, is that dead? Well, The Economist, which is a well-known magazine, came out with this article. It said the hedging relationship that underpins the 60-40 portfolio has fallen apart. Rising yields on bonds simply make volatile equities less attractive by comparison, so the prices of both assets have fallen at the same time. So it's basically saying that, if what's happened now is that equities have started to drop and yields on bonds are coming up, which has reduced the value of previous bonds. Really, really painful. You can see here, if you had a mix of stocks and bonds, 60-40, you'd be down 16.7% for 2022. And this, basically for a 12-month period, is just behind the 1931 and 1937 crash. So it's been a terrible year for stocks and for bonds. And I want to share why you should not be using this method. And as a former investment advisor, it's really rewarding to say that I basically feel like I have seen the Wizard of Oz looking behind the curtain and saying there is a better way. So we're going to jump into that. I'm going to get into why the 60-40 portfolio is dead and what another alternative is. So let's do it. Okay, so a quick disclaimer, I am not your investment advisor. I used to be an investment advisor. I call myself a recovering investment advisor, right? Because when I kind of discovered some of these things, that working to get people into stocks and bonds didn't really serve them. It was not actually a safe investment. It was not actually something that really helped people. And we're watching that now as the value of both are significantly coming down. And I'm just not a fan as much of paper assets for many reasons. So I did a video about this, that bonds are toast. I did a video on this basically a year ago where I said the value of bonds are going to crash. If you want to understand kind of how bond valuations work, and if you own bonds, I highly recommend that you check that video out. And basically, if you look at historically what's happened here, you see this chart where basically the yield of bonds went down for years. You can see the arrow, the bond yields just continually went down. What happens if you have bonds that are at a higher rate? Let's say a bond's paying 10%, which at one point, in the 80s, whatever, it was, that was common. And the bond valuation has just been coming down. If you own these 10% or higher value bonds, as long as the bond yields are going down, these bonds are worth way more, right? Well, now the reverse is true, right? We got to almost a zero, just maybe we're getting 1% or 2% bonds. Well, what happens now if now new bonds are being issued at 3, 4, 5%? It makes these bonds worth way less, right? And so we're seeing that. And so bonds are just absolutely getting destroyed. So if you own bonds, I'd be very, very aware. You've obviously experienced that in your portfolio. So really, why do people own bonds? It's because they want consistent cash flow. They want some sort of hedge outside of the stock market, and inflation is high, right? So there's some factors that kind of make this time really unique. Inflation right now, the CPI, at least December 2022, 7.1%. We call it the CP lie because it's not really actually true, because they don't actually compare things apples to apples. They'd say, if you liked apples and the price doubled, you'd switch to oranges, or there's all sorts of other substitutions they do. So shadowstats.com puts it at about 15%. So instead of 7%, it's about 15%. So this means it's basically a time of negative real interest rates. That means you can basically get an interest rate loan lower than 7.1% on a house, or definitely lower than 15%. And so which is really powerful. This time right now is not, it's a unique time that is actually the case, where interest rates are not actually above where inflation is. So right now, more than any time, saving is losing. If I have 100K in the bank, if I'm saving money, I'm losing. And there's a lot of people that are saving today and are waiting. And I think it's a mistake to just simply be having lots of money sitting in a bank and waiting for a better day, because you're losing money simply by keeping money in the bank. So, and actually I wanted to share this with you. There is an investor that I have that I respect a lot, who has a financial advisor who sent, saying, hey, I don't think you should invest in some of Bronson's deals, this multifamily, the ATM, some of these other deals. And this is a guy who has a lot of credentials, got a bunch of letters behind his name, a smart guy. But I responded to this investor who's really become a friend. I said, this person either is not wealthy, or they didn't make their money using these methods that they're talking about, which really are including stocks and bonds, because stocks and bonds There's, especially stocks, incredible amount of risk, ups and downs from just, you could lose 30 to 50% in 1 year, right? And we never see that in multifamily. We never see that. Sometimes I suppose single family, you could see that. There are certain parts of the country, there's leverage, there's other issues and risks there, but we're not seeing it. So I think when it comes to bonds and stocks and traditional methods, it's really important to kind of look outside of traditional investing. All right, so I was just sharing stocks are very risky, right? And we know that's true. Why do we feel like stocks are safe investments? I want you to think about that for a minute. Why do we think these are actually safe? It's because it really is a propaganda, right? It's a campaign that Wall Street spends billions of dollars to convince you that these are safe and secure investments. But in reality, if I told you this just out of the blue, I said, hey, I've got a great investment for you, and it's been around for a long time, but it basically, here's what it is. You could get 7 or 10% per year, but we've had multiple times that in a 12-month period, there's been 4, 5, 6, 7 times that we've seen a drop in 30 to 50% in a 12-month period. Is that something that you'd be interested in joining? It's like, well, no, I don't want to lose 30 to 50% in 1 year, right? Because if you lose that amount in 1 year, how many years you have to get back to where you were? But that's how we've been conditioned, right? It's through the marketing, it's through retirement accounts, it's through what's traditional, and we really are doing things where we kind of just turn our brain off and we say, you know what, this doesn't make any sense. If we're getting consistent double-digit returns without the volatility in multifamily real estate, why would I do these other things that there's so much volatility? Why would I do these other things such as stocks and bonds? Because particularly stocks, because they're so up and down. So if and this is just something to be interested about when you have a loss, if you have a 50% decline in the value of a stock or an investment in 1 year, the next year you have to have a 100% increase to get back to where you were, right? So let's say you had $1 million and you lost half of it, 500,000. Well, you'd have to go from 500,000 to $1 million, which is a 100% increase to make up what you lost, right? So just keep that in mind as you look at it. So really, what's the alternative? To me, I look at real assets. I'm 100% real assets. I love it. I think it's awesome. Multifamily real estate like this deal back here, I love that it's an inflation-hedged asset that pays you to hold it, right? So it basically, this asset that you own, you're able to buy it using debt that's not your money, and you pay it off with dollars that are worth less in the future. And when you hold it, you get cash flow from it, and it hedges inflation. I mean, what could be better than that, right? You're using not only just your money, you're using the bank's money. You know that it's going to be worth more in 5 or 10 years because of inflation, and you know that you get just incredible tax benefits, and you're getting cash flow, and it's hedging inflation. So it's a really, really awesome investment. If you haven't invested in multifamily, I highly recommend considering it. Also, another thing I like doing precious metals, physical precious metals. Now, these are not, I don't consider this an investment, but they can easily create more dollars, right? You can't easily create more gold or more silver. It costs money to get out of the ground, right? So it becomes a hedge against just creating more and more currency. And right now, the dollar, there's so many dollars that are being created, the more real assets such as this you can get into, it really helps. Also, if you own physical metals, it gets you out of something called counterparty risk. So stocks, bonds, paper assets, other things, there's different parties involved in that process. Even ETFs that do precious metals, they'll sell off many, many shares. Well, if any of those companies have trouble or there's liquidity or anything, you may not be able to you may not actually own what you think you own, right? So I think it's really important to consider when it comes to paper assets. So in summary, I'm not going to tell you what to do. I'm about 95% invested in real assets, multifamily or ATM machine fund, precious metals, different sorts of other real estate or other passive in the energy space. And I've seen my net worth go up about 20x in the last 4 years just by doing this and helping others to do it. And so I encourage you to take a look at real assets because they will not let you down. 60-40 portfolio, I think, is dead. I think it's really important to look at other things. Check out this quote by Warren Buffett. It says, "Wall Street is the only place where people ride to in a Rolls Royce to get advice from those who take the subway," right? So what happens is really wealthy people are taking advice from people that are not really wealthy. Just like I gave that example of my friend who's an investor who is, a guy who's giving him advice probably is not very wealthy because the advice he's giving him doesn't lead to really generating a lot of wealth. If you're interested in checking out that bond valuation video I did, it's up here. I have the whiteboard out and I explain how bond values work. I think it's important. If you own bonds, you should watch that video. And we have this great ebook I wrote. It's called How to Use Inflation to Your Advantage. It's a free download. It's 50 color pages. It's awesome. It gives all kinds of strategies. What do you do to invest in a time of high inflation? So check that out. We'll look forward to seeing you on the next video.